we are going to discuss important topics. So the first topic which we are coming up with today is GDP versus GNP. Now this table will clear each and every of your doubts, and you will be getting whatever questions from the Finance Commission will be coming, you will be getting it right. Now this very balance of payment is very, very important when it comes to your prelims exams. When it comes to our country's BOP data, who is compiling it? It is the Reserve Bank of India. This is important for your exams. And what is the effect when it comes to the high CAD? It puts a pressure on the Indian rupee. Then the foreign exchange reserve, it will decline because we have to pay more and more for our imports. So our foreign exchange reserve will decline. It can lead to inflation and also external vulnerability. These are the points they can ask you statement-based question. So that's why you should remember these points. Now, when we talk about the composition of the foreign exchange reserve, this is very important for your exams. I would request everyone, please go through these, you can say, quantitative tools in a very proper manner, because one question from here will certainly come. Hello everyone, welcome to Drishti IAS. I know that all of you must be very busy and very dedicated and focused towards your prelims preparations. But from our side, we want that preparation to excel. So Drishti, it has brought for all the students who are appearing for the prelims 2026. So in this booster series, we are going to discuss topics, important topics. I won't be saying that the entire economy part we are going to discuss, but the important topics related to economy. All of you know that in your prelims, like the other subjects, economics also has a very important, you can say, it also has an important place when it comes to your prelims exams. So that's why this particular entire session, I would request everyone to stay tuned and it's like a 3-hour session, 3 hour plus or minus you can say. But the maximum time for this session we have allotted is like 3 hours. So in the coming 3 hours, I would be discussing topics with you, and most of the topics will be in the PPT format so that we can cover up the topics. And all you need to do is that you have to be there for the entire 3-hour session, and also the important things you have to copy it down. Myself, I am Girish Venkatesh, and once again I welcome all of you. So the first topic which we are coming up with today is GDP versus GNP. That is gross domestic. The word here, D, refers to domestic, and the word here, N, refers to national. So it's gross domestic product or gross national product. Now all of you must remember that the difference between domestic and national is only nothing else but it is NFIA. And this NFIA, it is net factor income from abroad. And when I say net factor income from abroad, and in economics, that too in macroeconomics, whenever this word net comes, it is very simple to say that it is the subtractive value between two things. That is factor income received and factor income paid. Factor income received, when I say, then all of you must remember that whenever we are talking about factor income received, it means that all the Indians, when I say Indians, it can be individual, it can be institutions. When all the Indians who are outside the territorial boundaries of the country, who are outside the geographical boundary of the country, so their income, we consider it as factor income received from abroad. Whereas factor income paid is nothing else but it is to the foreigners, that is the foreign individuals and the foreign institutions which are operating or which are working within the domestic territory of your country. Yeah, within the political boundary of your country. So there the word factor income paid comes. That means these foreigners, because they are performing the economic activity within the domestic territory of the country, so it's a part of our domestic income and we call it as factor income paid. So whatever income they receive, whether it is in the form of wage or salary, whether it is in the form of interest, profit, it is referred as factor income paid to abroad. Then the second thing which I want to say here, so NFI is the subtractive value of these two things. Now the second thing I want to say here is, whenever we talk about domestic and national, please remember, domestic is something which is related to where the economic activity is performed. And when I am saying economic activity, it is related to production and all. So where is the economic activity performed? So it is place specific, domestic. It doesn't matter who is performing it, whether an Indian or a foreigner, but the economic activity, whenever I say domestic, it should be performed within the domestic territory of the country or within the economic territory of the country. So what is this economic territory? What is this domestic territory that we are every time telling? When I am giving you this definition, listen to the definition properly. You will understand it. Domestic territory, it refers to that geographical territory. Yeah, it refers to that territory which lies within the political boundary of the country. That means all the area which lies within the political boundary of our country, India, plus the territory where people, good, services, they can move freely. But what is very important is that the domestic territory, it is governed, yeah, it is administered by a government. So the territory which lies within the political boundary or geographical boundary of the country and within which people, good and service and even capital, they can move freely and is administered by a government. So this word administered by a government is very important. That means, take for example India, then the entire geographical territory within India, is it your domestic territory? I would say no. Why? Because take for example the embassies which are located in Delhi, or the embassies, foreign embassies which are located in your country. Are they your economic territories? Are they your domestic territories? No. Even though they are lying within your domestic territory, even though they are situated within India, but they are not considered part of India. Reason? That particular embassy, the area where the embassy is there, it is administered by that particular government. For example, if US embassy is located in New Delhi, in Chanakyapuri, then that area where the US embassy is located, there the rules and regulations will be as per the US government. No individual can enter without permission. So all the embassies which are located in your country, they are not your domestic territory. Or all the international organization buildings which are located, like for example, the building with regard to UNESCO, the building with regard to World Trade Organization. So all the buildings with regard to the international organization, they are not your domestic territory. Reason? They are administered by that particular international organization, for example, United Nations, and the rules and regulations are as per UN. It's not as per the Indian rules and regulations. That's why when we talk about Article 14 of your Constitution, there are privileges, right to equality, equality before law and equal protection of law. So there is an exception with regard to the officials who are working in the consulate, in the embassies and all. Okay? And also, when I talk about the difference, see, it's written here, the difference between the location of production, that is GDP, and the ownership of income, that is GNP. Location of production and the ownership of income. So GDP, it counts everything produced within Indian borders, regardless of whether the producer are Indian or foreigners. So all that is being produced by Hyundai, IBM or Toyota, they are a part of India's GDP. But what about GNP? GNP counts all production done by Indians, irrespective of whether they are working inside India or abroad. So all the Indian software engineers who are in US, they contribute to India's GNP, not GDP. I hope this part is loud and clear to all of you. Then gross domestic product, all of you must remember that gross domestic product, it measures domestic product capacity, and it is essential for understanding domestic employment. Remember it, GDP, it is measuring what? Your domestic production capacity. That means what is your country's production capacity? That is what is GDP is measuring. And because it is a macroeconomic concept, so please remember here GDP is C plus I plus G plus X minus M. C refers to the household. Household, they do private consumption expenditure. So this is with regard to the consumption expenditure on final goods and services done by the household. I refers to the investment. That is, the private firms and all, they do investment. Investment is also a kind of you can say final expenditure. Then G stands for government expenditure. That is government, it does expenditure on providing, on doing welfare activities, and even it does expenditure with regard to, whenever we are talking about here I, then remember this investment, it is on final goods, and G stands for government, and X minus M stands for the foreign sector, that is X is exports, M is imports. So GDP, actually it is essential in understanding domestic employment, demand, production efficiency, and also the cyclic condition of Indian economy. And in macroeconomics, the most used macroeconomic indicator GDP is C plus I plus G plus X minus M. What about GNP? GNP, it is nothing else but it includes cross-border earning of Indian residents. That is, it is done through net factor income from abroad. Now this is very, very important for your exams. Now these are the things you should remember. That is, if NFIA is positive, it means Indians earn more abroad than foreigners earn in India. So GNP will be greater than what? GDP. So if NFIA is positive, then GNP will be greater than GDP. And if NFIA is negative, then GNP will be greater than GDP. So simple, it is like N to G, N to D, you are going plus NFIA, and if it is GDP to GNP, so D to N, that is N to D you are going, then it is minus NFIA. So if you are finding GDP from GNP, so you have to do minus NFIA. If you are finding GNP from GDP, you have to do plus NFIA. So GNP is nothing else but it is GDP plus the net factor income from abroad. If the net factor income from abroad, it can be positive, it can be negative. Okay. So finally, what you can see here, it is the difference between GDP and GNP. Basis, this is territory, this is nationality. Got it? Here, foreigners who are residing in India, they are included. Here, the Indians who are abroad, they are included. And please remember, whenever I am saying foreigners or Indians, it is only not related to the individuals, but also the institutions. Okay. Then it excludes Indian abroads, it excludes foreigners in India. And what is the link? The link is this, that GNP is equals to GDP plus NFIA, and GDP is equals to GNP minus NFIA. Okay, it's minus NFIA. Clear, everyone? So this is the first, what is very, very important for you. Next topic. See, I'm not going in a very like first if we take the national income, then we will be going into the other parts. I'm not going to do like that. Okay. The topic number 2 which we are coming up with is with regard to your MSP. We all know MSP is the minimum support price. MSP is what? It is the minimum support price. Or you can call it as the support price. Okay, you can call it as the support price. Now, when we talk about MSP, then MSP, it is nothing else but it is a non-statutory price assurance. non-statutory price assurance, and it was announced by the Government of India, and that too before the sowing season for selected crops. Remember it. It is announced before the sowing season of selected crops. Got it? Next, it is announced twice a year. That is, Kharif crops ke liye it is announced in the month of June, and for Rabi crops it is like October. Okay, we all know there are two cropping seasons, Kharif and Rabi, and the third one is Zaid. But Zaid is nothing else but it is a short summer season crop like cucumber and all. Okay. So here when we talk about the announcement of MSP, it is twice a year, that is June and October, and it is recommended by CACP, that is an expert body which is under the Ministry of Agriculture. It is an expert body which is under the Ministry of Agriculture. Okay. So when we are talking about MSP, so all of you must remember it is a non-statutory price, you can say assurance, announcement. It is done twice in a year. Okay, twice in a year the announcement is being done, and the very important, recommended by CACP. Now when I say CACP, it is Commission for Agriculture Cost and Prices. Remember it, it is Commission for Agriculture Cost and Prices. And MSP, it is also referred as floor price. It is also referred as floor price, or it is also referred as support price. Okay? And this CACP, it is what? It is the Commission for Agriculture, Commission for Agriculture Cost and Price. Okay? Commission for Agriculture Costs and Prices. Got it? And it is an expert body under the Ministry of Agriculture, and it is approved by CCEA. Approved by CCEA, it is Cabinet Committee on Economic Affairs. Remember it, it's Cabinet Committee on Economic Affairs. Okay, then next thing is that it is operationalized through procurement by FCI, that is the Food Corporation of India, then NAFED, NAFED, that is for pulses and oilseeds, then CCI for cotton, JCI for jute, and the state agencies. So which are the central nodal agencies? When I say the central nodal agencies, the central nodal agencies are FCI, NAFED, then CCI, and then there is the JCI. Currently, you can say 22 crops are there under the MSP. In that, 7 are cereal crops, 5 are pulses, and 7 are oil seeds. Okay? 7 are oil seeds. So this is the table which you people should remember with regard to the 22 mandated crops. That is cereal 7, paddy, wheat, jowar, bajra, maize, ragi, barley. And in pulses, you have 5, that is tur, moong, urad, gram, that is chena, and masoor, that is lentil. Then in oil seeds, it's groundnut, soya bean, sunflower seed, sesame, niger seed, rapeseed, mustard and safflower. Okay. Then others, we have 3, that is 14 plus 5, 19. Okay. And then others, you have 3, that is copra, dehusked coconut and raw cotton and raw jute. So this is with regard to the categories and the crops. And remember, sugarcane, it has a separate fair and remuneration price, which is notified by the Cabinet Committee on Economic Affairs, and that too on the advice of CACP under Sugarcane Control Order 1996. So this is distinct from MSP. Remember it. This is the twist. Sugarcane, they can ask you, sugarcane is not included in this 22 list. Remember it. Sugarcane, it's not included in the 22 list. It is a separate fair and remuneration price notified by, it has a separate fair and remuneration price, FRP, which is notified by the Cabinet Committee of Economic Affairs, and that too on the advice of the Commission of Agricultural Cost and Prices, and that too under the Sugarcane Control Order 1966. Then how is this MSP calculated? Now MSP, it is the CACP which computes the cost of production, and it computes using these 3 methods. One is the A2, then the other one is the A2 plus FL, and the third one is the C2. A2, what it is including? It is including out-of-pocket expenses. Out-of-pocket expenses in the sense for the purchase of seeds, fertilizers, pesticides, labor, fuel, irrigation, machinery, these all things when we hire, then that is what is A2. So A2, it includes out-of-pocket expenses. And when we talk about A2 plus FL, then A2 plus FL is, you can say A2 is there and FL is the family labor. That means I have a family of 5 people. All the 5 people are working in that agricultural field. It means it is an imputed value. Do you know imputed value? Imputed means I am using my own labor. So when I am using my own labor, so this is something related to imputed cost. So this is the imputed value of family labor. So that is added to it. And the third one, it is the C2. C2 has A2 plus the imputed value of family labor plus the rental value of owned land. Rental value of owned land plus the interest on owned capital and also the depreciation. So this is rental value of owned land means imputed rent. You can call it as imputed rent. That means the land is mine. I am using it for my own agriculture. If I would have given it to someone, I would be getting rent. So I consider it as rental value of owned land. That means imputed rent is included. Then I have put my capital, like for example, I have purchased threshing machine, I have purchased a tractor. So I have put investment. So for that, I would be getting interest to myself. So that is imputed interest in the sense. Okay? And the last one is depreciation. So all of this are added to A2 and FL. Got it? Clear everyone? So 3 methods. One is A2, A2 plus FL. FL is the family labor. Now that is with regard to imputed value of family labor. So this is with regard to imputed rent, and this is imputed interest. ठीक है, got it? चलो. And very importantly, let me do it. The National Commission on Farmers, this one was in 2006, MS Swaminathan, always his name comes up. So it's the National Commission for Farmers. What he recommended that MSP must be C2 plus 50% margin as a fair benchmark. That means the National Swaminathan Committee or Swaminathan Commission, which was, you can say, constituted in 2006, the recommendation he did was that the MSP, it must be equal to the C2, that is A2 plus FL plus imputed rent, imputed interest and depreciation, and that should be added to a 50% margin as a fair benchmark. But what is the government's official position since 2018-19? The government's official position is MSP is fixed at least 50% above A2 and FL, not C2. So this is what is the Swaminathan Committee and the government stance. So this is what is the conflict. Swaminathan Committee said that C2 plus 50%, ठीक है, C2 plus 50% margin, and the government says that no, it is not C2 plus 50%, it will be A2 plus FL, and that will be plus 50% with regard to that. So this gap is the heart of Swaminathan formula versus the Government of India formula. Okay, so this is what is the calculation. Clearly you must have understood. Now the next question pops up, that why A2 plus FL was chosen. That means when we are doing the computing, why A2 plus FL? That is family labor, because it is easier to compute and audit. It avoids inflating MSP. Okay. Then C2 includes national land rent, which varies widely by region. Standardization will be what? Difficult. And farmers, they are demanding what? Farmers are demanding C2. And why farmers are demanding C2? Because the tenant farmers, what they do, they pay actual land rent, which is not included in A2 plus FL. There are tenant farmers who will be paying land rent, but in this A2 plus FL, the land rent is not included. So the farmers who are basically tenant farmers, they say that C2 must be there. Then owned capital depreciation, that also erodes net returns. That means whatever profit you are getting, that is good, you are getting profit. But in long run, what happens? You have capital, like for example, you have tractor, you have threshing machine and all. Then what will happen? The value of those things will depreciate. So when the value of those things depreciate, your net returns, what happens? It erodes. And also there were economists like Ashok Gulati, Ramesh Chand and Ashok Dalwai who had argued that C2 based MSP would make pulses and oilseeds genuinely competitive with paddy and wheat. Okay, they said that it would make the pulses competitive, pulses and oilseed competitive with paddy as well as, you can say, wheat. Paddy is something which is with regard to your rice. And when we talk about the MSP, you must remember MSP's origin, it traces back to 1965, and that is when the Agricultural Prices Commission, which was now renamed as CACP, at that time it was 1965, it was Agricultural Prices Commission, and that was set up, and that too at the backdrop of food scarcity. And also the PL 480 wheat dependence. And the first MSP, remember it, the first MSP, it was announced for wheat in 1966-67, and this one was so as to you can say give an incentive to the green revolution. So that is what. And then there is an expansion to the MSP 70s and 80s. Now in 17 and 80s it started covering paddy, cereal, pulses, oil seeds, cotton, jute and all. And then we can say that today we have like 22 crops which are covered under the MSP. Okay, 22 crops. So, and there are government schemes and all, like MSP procurement, it is through FCI, NAFED and CCI and JCI. These are the nodal agencies. Then food subsidy, as I have already said you, it is then PM ASHA also I have already said you. Then NFSA, that is National Food Security Act. Here 81 crore beneficiaries through public distribution system. This was continued through from the corona times. Then it's the PM Garib Kalyan Anna Yojana. So free food grains have been provided and it is extended through 2028. Okay. Then Operation Greens, that is the perishable prices stabilization. Okay. So that is what is there with regard to your MSP. So our second topic with regard to the MSP, that has come to an end. Now, very interestingly, the third topic which I will be covering here is with regard to the Finance Commission. Now, we all know that the Finance Commission under Article 280 of the Constitution, it has been constituted by the President after every 5 years. We know about that. Okay. So, when we talk about Finance Commission, then the Finance Commission, it is India's financial empire, and every 5 years it decides how money is collected by the central government and it is shared with the states. So without this mechanism, richer states would stay rich, poorer states would struggle, and the federal structure of India would break down. So Finance Commission is the financial umpire. That means it is deciding as to how money is collected by the central government and how it gets shared with the states. That means devolution. There can be vertical, there can be horizontal devolution. We will study about that, all things. And constitutional article, you should know about it, Article 280, constituted by the President of India every 5 years. Composition, there is one chairman and there are 4 members. Then it is a quasi-judicial body. It is a constitutional body as well as it is an advisory body. Quasi-judicial, constitutional as well as advisory. And whatever is the report of the Finance Commission, it is laid before the Parliament, and that too under Article 281. Then the Finance Commission also looks into the grant in aid. We all know that there are statutory grants and all, discretionary grants, statutory grants. So under Article 275, the grants in aid, the Financial Commission looks into that. Then when we talk about the divisible pool, then the gross tax revenue minus collection cost, cesses and surcharges. Okay. So whatever is the divisible pool means which is to be distributed among the states and the center. Okay. And remember, cesses and surcharges are not shared with the states. This is very, very important. Cesses and surcharges are never distributed with the states. Okay, and this is a major point of criticism by the states, ki why the cesses and surcharges are not distributed. So when we talk about the distribution amount, so it is calculated whatever is the gross tax revenue, from that collection cost is subtracted, cesses and surcharges, they are also subtracted. Okay, got it? There are two types of devolution. I said it must be distributed. So two types of devolution. One is the vertical devolution, one is the vertical devolution and the other one is the horizontal devolution. Horizontal is something like this and vertical is something like this. So vertical devolution is how much of the central tax pie goes to all states combined. How much of the central tax pie, that means how much of the central tax that goes to all the states combined. It is like 41% of the national tax cake goes to the state. That means if there is a cake, then out of that 41% goes to the states. The rest is with the center. Then the horizontal is like this. Vertical is like this. That means vertical says that how much of the central tax pie goes to all the states. It is 41%. Then how horizontal devolution is how that state share is divided among individual states. That means how is this like 41%? It has been divided by the individual states. Like for example, Kerala, it will be getting like 2.4% of this. UP will be getting 17.6% of that 41%, like that. So this is what is vertical devolution and the horizontal devolution. So vertical devolution is central tax, how much of it goes to all the states combined, and horizontal is that how the states share, that is the total state share, how it is divided among the individual states. Okay. Next, there is a difference between Niti Aayog and Finance Commission. You must know it. Ki constitutional status, if you say Finance Commission is a constitutional body, but Niti Aayog, it is an executive body because it was established by an executive order. So it is not a constitutional body, it is an executive body. But Finance Commission is a constitutional body as per Article 280. When we talk about the nature, then Finance Commission is statutory, independent and quasi-judicial. It is statutory, independent and quasi-judicial, but it is just an advisory think tank. Then on tax sharing, legally binding recommendations, no role. Niti Aayog does not have any role when it comes to tax sharing. Yes, Finance Commission does give recommendations which are legally binding. When we talk about reconstituted, then every 5 years it is constituted, it is permanent till dissolved. And here headed by the chairman, that is appointed by the president, and here it is headed by the Prime Minister, who is the ex officio chairman. Clearly, you must have understood this. Then, when we talk about the basis with regard to the Finance Commission, December 2023 constituted, 31st December 2023, the 16th Finance Commission constituted by the President under Article 280, and Dr. Arvind Pangaria was appointed as the chairman. Remember it. When was the 16th Finance Commission constituted? It's December 31st, 2023. Then after that, November 2024, the terms of reference was accepted, November 2024. And the Union Cabinet formally accepted the terms of reference of the 16th Finance Commission. And then the commission, it visited all the states and UTs, and then also it held consultations with the central and the state government. So November 2024 is with regard to this. Then November 2025, the report by the 16th Finance Commission is submitted. That is, it is submitted to the President, Srimati Draupadi Murmu ji. So Chairman Arvind Pangaria, he is submitting the report to the President Draupadi Murmu ji, and copies also presented to Prime Minister and the Finance Minister. So the entire report is submitted 17th November 2025. Okay, look at that. Then February 2026. February 2026 is what? It is tabled in the Parliament. 1st February 2026. 16th Finance Commission report is tabled in the Parliament, and that too alongside the Union Budget 2026-27, and that too under Article 281. Remember it? 281 talks about tabling of the Finance Commission report in the Parliament, and the government, it accepted the key recommendations, including 41% vertical devolution. That means the total central tax pie, out of that 41% will be going to all the states. Now the horizontal is something which we have to discuss. And please remember, the April 2026 award period begins. 1st of April 2026, so the award period has begun. So, and the 16th Finance Commission, you can say the running period, it's called as the award period. Okay, so it's to 2026-27 to 2030-31, and the states begin receiving devolution under the new formula. Okay, so the chairman and the 4 members, 3 are full-time, 1 is part-time. Part-time is Soumya Kanti Ghosh. You should remember the names. Okay, they can ask you the names. Now, let me show you a table. Now, this table will clear each and every of your doubts, and you will be getting whatever questions from the Finance Commission will be coming, you will be getting it right. So, once again, I'll say that this is the booster session which is there in your Drishti YouTube channel. And this is for your 2026 prelims exams. So I hope so you all are getting good knowledge, you all are having a good time here with us. So kindly I would request everyone to stay tuned till the video ends, till the discussion with regard to the topics, it comes to an end. So let's talk about, now let's come into the 15th and the 16th Finance Commission. How about using this table and trying to know each and everything? Now, when I talk about the criteria, that is the income distance in the sense per capita gross state GDP gap, then 15th Finance Commission, it's 45%, and 16th Finance Commission, that has been reduced. 16th Finance Commission, it has been reduced, that is 42.5%. Now, when I talk about the population, 2011 census is being taken. So, 15% is here the population, 17.5%. That means population is something which is being increased here. So when I say income distance reduced, then income distance reduced, that means slightly reduced. Slightly reduced. That means the poorer states, they are getting little less extra weight. That is what. And when I talk about the population, then the population has been increased from 15% to 17.5%. So when the population has increased from 15 to 17.5%, it means that the bigger states, the larger states, they are going to benefit. ठीक है? And particularly with that of the north, ठीक है, which have higher population. Then the demographic performance. It is total fertility rate, sorry. So demographic performance 12.5%, and here it's 10%. So it's reduced and it's redefined. Then the area is 15% and 10%. So area is also, you can say, reduced. Forest cover, here 10%, dense forest only. Here 10%, it is including open forest. So it's the same weight, but the scope has been expanded. Here it was only the dense forest was taken. Now here open forest are also taken. Tax and fiscal efforts, they were there in the 15th Finance Commission. In the 16th Finance Commission, it has been removed. And now a new thing has been added, that is contribution to the GDP. This was not there in the 15th Finance Commission. A new parameter with regard to contribution to GDP, that is 10%. So this is what is the weightage. Okay. So this is what is the weightage. So the criteria with regard to the weightage is income distance, population, demographic performance, area, forest cover, and contribution to GDP. This table, you have to know it. Okay. We also have this, that the Finance Commission, it also recommends grants in aid to states, and that too under 275 article. Now what the 16th Finance Commission has recommended, it has recommended a total of rupees 9.47 lakh crores in grants. This figure you have to remember, 9.47 lakh crores in grants for the 5-year period, and that too with a simplified structure as compared to the 15th one. Grant type C, revenue deficit grant. Revenue deficit in the sense, your revenue expenditure, when it gets more than your revenue receipts. So that is what is revenue deficit grant. So revenue deficit grant, it was provided by the 15th Finance Commission. Now this has been discontinued. You have to remember that what are the grant types which have been discontinued by the 16th Finance Commission. It is the revenue deficit grant, it is the sector specific grant. That means 15th Finance Commission, it was providing grants with regard to health, education and all, that has been discontinued. Then state specific grant, that has also been discontinued. But local body grants, it was provided, and here also it is provided, and it is said to be 4.4 lakh crores. Then local body grants urban provided, here also it is provided 3.6 lakh crores. Disaster management grant, it was provided, now this has been to 2.04. So these three are continued in both the cases. Then two new parameters, two new grant types have been introduced. One is the special infrastructure grant. Urban areas, for urban areas there is a special infrastructure grant which has been introduced by the 16th Finance Commission, and the grant allotted is 56,100 crores. And urbanization premium grants, this is also a new type of grant which has been introduced, which is 10,000 crores. So when we compare the 15th and the 16th Finance Commission, then the grant in aid to the states, many of the grants have been discontinued. 2 new grants have been added. The 3 new grants which have been discontinued as per the 16th 5-year plan, which was there in the 15th, that is revenue deficit grant discontinued, sector specific grant discontinued, state specific grants discontinued. 2 new grants are added: special infrastructure grants, urban and urbanization premium grants. These are the 2 new grants. And which are the 3 grants which have been continued? It is local body grants rural, local body grants urban, and the disaster management grants. Got it? Clear? And what about the fiscal roadmap? That means center's fiscal deficit. The recommendation is to reduce it to 3.5% of the GDP by 2030. When I am saying fiscal deficit, the other name to fiscal deficit is borrowings. And borrowings is a liability. Remember it. Fiscal deficit is equal to the borrowings. So the 16th Finance Commission, its target for the central fiscal deficit is that it is to be reduced to 3.5% of the GDP by 2030-31. And for this long-term fiscal sustainability for union government. Then state's fiscal deficit, an annual cap of 3% of gross state domestic product. So state's fiscal deficit, it has recommended that it should be 3% of the gross state domestic product. That means to prevent excessive state borrowings, it has put an annual cap of this. And off-budget borrowings strictly discontinue, include in official state budgets. Okay? And combined debt, it's to decline from 77.3% to 73.1% of the GDP by 2030-31. Okay? So combined debt also has to be reduced. And then subsidy definition, there must be a uniform framework, transparent it should be, and that is what. So key number which you have to remember is 3%, and this 3% is the annual cap for the gross state, 3% of the gross state domestic product. This is state's fiscal deficit, and the union or the center's fiscal deficit is to be reduced to 3.5%. Okay, 3.5%. So these are the 2 very important numbers from the 16th 5-year plan for your very prelims exams. Remember it. Okay. Now, so the entire Finance Commission is also, in one way, it's finished. So till now, we have completed the Finance Commission, MSP, and also with regard to GDP and GNP and all. Okay. So these are the topics which we have covered as such. Now, the next topic which we are going to start is with regard to the balance of payment and also with regard to the current account deficit. Okay, balance of payment. Now this very balance of payment is very, very important when it comes to your prelims exams. Now whenever I say BOP, it is based on what? It is based on double entry bookkeeping. When I say double entry bookkeeping, then in that double entry bookkeeping, there are 2 sides. One is the credit and the other one is the debit. Remember here. One is the credit. So BOP has a credit side and a debit side. The credit side is nothing else but it is inflow of foreign currency. And this is outflow of foreign currency. So inflow of foreign currency is the credit side and outflow of foreign currency is the debit side. So this is regarded as the positive side and this is regarded as the negative side. The very important thing. So that's why we say it is a double entry bookkeeping system. On accounting sense, it is never balanced. On accounting sense, it is never balanced. But because we follow the double book entry keeping system, so that's why this financial statement, BOP is a financial statement. So this financial statement, it is always balanced. It is always balanced. So double book entry keeping system, and whatever are the transactions, they are a credit, that is inflow, or a debit, that is outflow. So one more thing I can say, that this BOP, it records economic transactions. And whenever I say economic transactions, now these economic transactions like visible items, invisible items, then current transfers and capital transfers. Current transfers, if you are feeling that it's somewhat difficult for you, you can call it as unilateral transfers. Unilateral transfers means one-sided payment, like in the form of gift, donation, and so on. And there are capital transactions. Capital transactions in the form of direct investments, portfolio investments, then borrowing or lending. So these are the capital transactions. Okay. So BOP always records economic transactions. And these economic transactions can be in the form of visible items, that is goods, invisible items, that is services, and unilateral transfers and capital transfers. So the BOP, as I said, you always balances in accounting sense, because any deficit in one account is offset by surplus in another or by changes in reserve. Okay? If there is any deficit in one account, for example, if there is a deficit in the current account, then the capital account will try to cover up that deficit. Or you can say by changes in the reserve. Okay? Now, when I talk about the BOP account, then the BOP, it has three main components. One is the current account, capital account, and the financial account. Current account, basically, it is with regard to the trade of goods, services, income, and transfers. That means current account, it is talking about the visible items, that is the goods, invisible items, which includes services and income, and the unilateral transfers. So this is with the current account. And when I say capital account, then it is with regard to the capital transfers, that is with regard to acquisition or disposition of non non-financial assets. Okay, non-financial assets. Financial assets are like shares, bonds and all. Non-financial assets like land, house, these are non-financial assets. That means I go to America, I buy a house there, then it will be a part of capital account BOP. Why? Because I have acquired a property. So with acquiring a property, the ownership also I have acquired. But to acquire that property, what I have done, I have spent money, I have spent foreign currency. So that is with regard to what? Outflow. That is with regard to outflow. But if foreign direct investment is being done in India, that foreign direct investment which is coming to India, that is a part of capital account BOP. But with that foreign direct investment, foreign currency is coming. So it is on the credit side. It is on the credit side. So in this way, like with regard to the trade of goods, we all know that export and import of goods is referred as what? Merchandise. So when I say export of good, it will go to the credit side. Why? Because with that export, we are receiving foreign currency. But when I say import of goods, that will be on the debit side. Why? Because we are paying. That is, we are paying outflow of foreign currency. Got it? In the same way, we have service, that is the invisible items. Invisible items, I'll give you an example. Like for international trade, you need shipping, banking and insurance. These are the three services which you need for international trade. Now, for example, all these services, they are owned by Indians and they are hired by foreigners. So when they are owned by Indians and they are hired by foreigners, so that refers to what? That refers to the credit. Why? Because the foreigners will be giving currency, foreign currency. They will be paying for what they are hiring. So it means it is credit inflow. But take it on the opposite side. If all these services, that is shipping, banking and insurance, they were to be owned by the foreigners, for example, foreign company or foreign government or foreign individual, and India was going to hire it, then what will happen? It is outflow. Why outflow? Because here we have to pay for the services which we are hiring. So it will be recorded on the debit side. Now I said you that we are going to make investments. Investments like investments with regard to acquiring property abroad. So remember it, there are certain factor incomes. Now for example, rent, profit, interest, these all are investment income. Now when we receive the investment income, that is a part of credit, and when we pay these interest, rent and all, that is a part of the debit. Okay, and what about the transfers? I said you unilateral transfers. Unilateral transfers means receipts of unilateral transfers. That is receipts of gift, donations and all. That is credit. And payment of gifts, donation or payment of the unilateral receipts, that is recorded on the debit side. Okay. And the third one is the financial account. Now this financial account, it includes foreign investment, loans and reserve assets. Foreign investment, loans and reserve assets. Got it? Now in India's BOP classification, following the IMF's BPM6 standard, what is commonly called the capital account includes both capital and financial account. That means this particular capital account, it includes both capital and financial account. And the Reserve Bank of India, remember, it compiles India's BOP data. This is very, very important. when it comes to our country's BOP data, who is compiling it? It is the Reserve Bank of India. This is important for your exams. The second thing here is that when it comes to the international standard, it is the IMF's Balance of Payment Manual, BPM6. It is the Balance of Payment Manual, IMF's. This IMF's Balance of Payment Manual 6, it provides international standards. These two things you have to remember. And it was the IMF's Balance of Payment Manual which talked about the financial account. So with regard to that, we have three: current, capital and financial account. This financial account is included in this capital account itself. Okay. Now let's talk about the current account. I have said you a lot of things with regard to the current account. So current account, it records transactions in goods, services, primary income and secondary income. And when I say current account deficit, it means a country is spending more on more foreign currency than it is earning. That is capital, requiring capital inflows to finance the gap. That means current account deficit is when you are spending more foreign currency with regard to goods, services and all, and you are receiving less, you are earning less. So to tackle this current account deficit, what you require? You require capital inflows. That is capital inflows in the form of borrowings and all to finance this. Now, when I talk about the trade in goods, it is called as merchandise trade. I did tell you. Export and import of goods, that is physical goods. And India typically runs a merchandise trade deficit. Remember it. India has a merchandise trade deficit. That means imports exceed exports. And crude oil, it is the largest import item. Okay? And there are other export items also, but the largest import item is crude oil. Okay. Then we have the trade in services. When I talk about the trade in services, then here it's the invisible, that is the IT and the business services, tourism, transportation, financial services and all. And India has a significant surplus when it comes to the trade in services. So we have a trade deficit in goods, but when it comes to the services, we have a surplus. And this surplus, it offsets the trade deficit. I said you na, ki when there is a surplus in one sector, it is being, there is a deficit in one sector, it is being offsetted by the surplus in the other sector. Then primary income, I did tell you, there are investment incomes like dividend, interest, which are earned by residents on foreign assets and paid to foreigners on their Indian investment. Okay? So this is, and also compensation of employees, and in this India has a typically deficit. That means foreign investment earn more from India than Indian investors. And then when we talk about the secondary income, that is the transfers, we all know the remittances from Indians who are working abroad. India has the world's largest recipient of remittances. India is the world's largest recipient of remittances. This is a very, very important point with regard to your, you can say, UPSC Prelims. Okay? And these are like one-way transfers, like for example, grants and donations, and a major positive contributor to India's current account. Okay? So current account, it has trade in goods, trade in services, ठीक है, and India has a surplus trade in services, okay, and then we have the primary income, that is investment income in the form of dividends, interest and all, profit and rent and all, wages and salary. But India has a deficit when it comes to primary income. Secondary income, remittances. India is the country which receives world's largest recipient of the remittances, and this is what is the major contributor when it comes to India's current account. So overall, if I put it in this format, you can understand it in a very simple manner. When it comes to merchandise trade, we are in deficit. That is, imports is more than exports. When we are in the service trade, we are in a surplus. When we are in primary income, we are in deficit. And primary income in the form of what? Investment income. And when we are in the secondary income, again we are in surplus. But when we talk about the overall current account, usually India has a deficit current account. Okay, that a current account deficit of 2.5% of the GDP. It is considerable, manageable for India. Okay, so that is what is with regard to the current account. So we are in a current account deficit, that is under 1% to over 4% of the GDP, and current account deficit of 2.5% of the GDP, it is considered to be manageable. Okay. Now what about the capital account? The capital account, I said you, it also includes the financial account. Now, when I talk about the capital account basically, it is the economic transaction between, or you can say, cross-border investment flows. It's the cross-border investment flows, loans and banking capital. And when I say capital account surplus, it means more foreign money is flowing into the country than flowing out. And this capital account surplus, it will finance the current account deficit. And in very simple terms, you should know that the capital account, it records all the economic transaction which leads to a change in ownership and liability. Ownership with regard to the assets and also with regard to the liability. Okay. Now, one of the components of the capital account is foreign direct investment. See, investments are of two types here. One is direct investment and the other one is portfolio investment. In direct investment, what happens is that when you do investment, you acquire the ownership rights also. Like for example, I said that I bought a house in US. So I did the investment and I got the ownership rights. I became the owner of that property. But portfolio and foreign direct investments is this. But when I say portfolio investment, these are investments with regard to the bonds, shares and all. So here you are doing investment, but you do not get the overall ownership rights. You do not have control over the administration. Like for example, if I purchase shares with regard to the British government, then do I have control over the British government? Do I have ownership over the British government? I am just a shareholder who has invested in the shares with regard to the British government. So that is what is portfolio investment. So it is with regard, the difference basically is with regard to the ownership rights. So here when I talk about foreign direct investment, then it is a long-term investment where foreign entity acquires 10% or more equity in an Indian enterprise. That means a foreign entity will acquire 10% or more equity in an Indian enterprise, and it is considered to be the most stable form of capital inflow, and it is governed by the FDI policy. And we all know that there are two routes. One is the automatic route and the other one is the government approved route. So there are two routes with regard to the FDI. We'll discuss about the FDI later on. Okay, don't worry. But you must remember one of the component of capital account is FDI. The second one is foreign portfolio investment. And as I said, it is investment in stocks, bonds and financial instruments. It's more volatile than FDI. It's more volatile. So it's a type of hot money, and it's regulated by what? SEBI through FPI framework. Okay, and this is regulated by the government, remember it. Okay, then we have external commercial borrowings. External commercial borrowings means loans from foreign commercial banks and institutions. Foreign commercial banks and institutions, and this is being regulated by the RBI through ECB guidelines. Okay, that is what. Then we have the NRI deposits also. Okay, NRI deposits, that is the non-resident Indians, they deposit in the Indian bank accounts, and this is also a significant source of stable capital inflow. Then we have banking capital, like net foreign assets and liability of the banking sector, and also with regard to the other capital like trade credits, short-term loans, advances and so on. Okay, so current account has the components: capital account, FDI, FPI, external borrowings, NRI deposits, banking capital and other capital. As I said you, FDI and FPI, this is long term and it is strategic. This is short term and it is portfolio. FDI is long term and it is strategic. This is short term and it is portfolio. Equity share stake is 10% or more, and here it is less than 10%. Control, managerial involvement. That means you have the entire management control you have. No management control. Stability, it's high. Stability is high because it is difficult to reverse, but here it's very low. Why? Because it's very volatile. The prices, they can go up and down. Okay. Then example, like a foreign company setting up a factory in India. Now here foreign funds buying Indian stocks. So here when foreign funds buy Indian stocks, this will be recorded in the credit side. But when Indian firms buy foreign stocks, that will be recorded on the debit side. And this is being regulated by DPIIT and RBI. Okay? It's been regulated by DPIIT and RBI. Okay? And DPIIT is nothing else but it is the Department for Promotion of Industry and Internal Trade. Okay? And that is been by SEBI and RBI. Okay? So this comparison is very, very important. Okay? This comparison, it is very, very important for you. Now when I say current account deficit, so current account deficit is when import of goods plus transfer payments, it exceeds exports and receipts. So the formula is total current account payment minus total current account receipts. Or simply, we can say that when current account balance is negative, whenever your current account balance it is negative, then you have current account deficit. Now, our country, it faces current account deficit. Why? Because we have to import crude oil, we have to import gold, electronic imports, our export is weak, and also there is a global slowdown. And what is the effect when it comes to the high CAD? It puts a pressure on the Indian rupee, then the foreign exchange reserve, it will decline because we have to pay more and more for our imports. So our foreign exchange reserve will decline. It can lead to inflation and also external vulnerability. These are the points they can ask you statement based question. So that's why you should remember these points. Now when I say that is current account deficit always bad? No, not. Why? Because current account deficit, it occurs when capital goods are imported, there is investment, infrastructure investment, okay. But current account deposit, it is not always bad because it can result to capital goods import. Capital goods in the sense, those goods which will be helping in our production process and all, plus investment in investment. Then what will happen? Infrastructure, this will all lead to long-term growth. So when it is only for consumption imports, then that is bad. And current account, it is deficit, it is financed through foreign direct investment, foreign portfolio investment, external borrowings, and also foreign exchange reserves. Okay. And finally, we can say that a trade deficit and CAD, trade deficit only goods, that is trade deficit is value of imports is greater than value of exports of goods. So here goods are important. But current account deficit, it is a wider concept. Why? Because it also includes, you can say, services and also current transfers. Here the formula is export minus import of goods. Here goods plus services plus transfer plus income. It's a narrow measure and it's a broad measure. Narrow measure, why? Because it is a part of that current account. BOT, balance of trade, it is a part of that current account. So that's why this is a narrow measure and that is a broader measure. Okay? And we all know that we have a capital account surplus. Okay? We have a capital account surplus and we have a current account deficit, capital account surplus. And why we have a capital account surplus? Because FDI and FPI inflows, it offsets the current account deficit. Okay? And foreign exchange reserve jo hai, it is managed by the RBI. We all know RBI is the custodian of foreign exchange reserve. And if the current account deficit rises, then the capital inflow are insufficient. And foreign exchange reserve will what happen? It will fall. Okay? Got it? So one more topic we have finished. So the next topic which you are going to cover up now, that will be foreign exchange reserve. Okay? So this is the topic which we'll be covering. What is there in this foreign exchange reserve? We also call it as what? Forex reserve. And it's nothing else but it is the stockpile of foreign assets which is held by the country's central bank. That means when we talk about the foreign exchange reserve, the custodian of the foreign exchange reserve in the country, it's the RBI. So you must remember that foreign exchange reserve or Forex, it is the stockpile of foreign assets and it is held by the country's central bank, that is the RBI. And why it is held? So as to back its currency and external obligations. So who is the one who is maintaining the foreign exchange reserves? It is the RBI. Remember that it's the RBI. Now when we talk about the composition of the foreign exchange reserve, this is very important for your exams. You must remember that when we talk about India's foreign exchange reserve, it consists of four major components. What? Consists of four major components. The first one is foreign currency asset, FCA, that is the foreign currency assets. The second one, it's the gold reserves. The third one, it is the special drawing rights, SDR. And the fourth one, it is the reserve tranche position, that is RTP. So what are the four major components of India's foreign exchange reserve? You must remember it for your exams, and it is foreign currency assets, FCA, gold reserves, special drawing rights, SDR, and reserve tranche position. Got it? Now, when we talk about the foreign currency assets, this is the largest component. So, when we talk about the foreign exchange reserve, foreign reserves, exchange reserves, then the largest component of the foreign exchange reserve, it is with foreign currency assets. That is what I'm telling. And it is held in the form of major currencies like US dollar, euro, pound sterling, Japanese yen, and so on. Okay, and usually forms around majority share, that is 85 to 90%, that is the US dollars in our foreign currency asset. It's usually it is the majority share, that is 85 to 90%. Okay, so the first component of the foreign exchange reserve is the foreign currency assets. Okay, and this foreign currency assets, it's the largest component of our country's foreign exchange reserve, and it is held in the form of major foreign currencies of different countries, but 85 to 90% of this particular component has the US dollars. Then the second one is the gold reserves. Gold reserves, the gold which is held by the RBI, and it is stored domestically also, and it is stored abroad also. Like for example, in RBI has gold reserves with institutions like the Bank of England. So it acts as what? It acts as a safe asset. So gold reserves, they are held, they are nothing else but the gold which is held by the RBI. They can be domestically stored, they can be stored abroad, like for example in the Bank of England. Then comes the special drawing rights. Now this special drawing rights, it is created by the International Monetary Fund. And this special drawing rights, it is nothing else but it is an international reserve asset. It is not basically a currency, it's an international reserve asset. And it is based on basket of currencies. Now what is the SDR basket? The current SDR basket, it includes 5 currencies: US dollars, euro, Chinese yuan, Japanese yen, and the pound sterling. Remember that. So it is not a currency. Remember that it is not a currency, but it is based on the basket of currencies. And in this basket, there are 5 currencies which are there: US dollar, euro, Chinese yen, Chinese yuan, Japanese yen, and pound sterling. Got it? And the final one, this is also maintained by the International Monetary Fund, and it is the reserve tranche position, RTP. Reserve tranche position. That is the amount which India can immediately withdraw from the IMF, and this is the smallest component. That is the amount which India can immediately withdraw from the IMF, and it forms the smallest component. So got it? The four components, largest component is which one? It is the FCA, that is the foreign currency asset. Then comes the gold reserve, which is with the RBI. It can be stored domestically or abroad. Then the third one, I said special drawing rights. It is being created by the IMF. It is an international reserve asset. It is not a currency. Rather, it is based on basket of currencies. And the basket of currencies which includes are 5 currencies. One is the US dollar, then euro, then the Japanese yen, the Chinese yuan, and the pound sterling. And the last one is the reserve tranche position. This has been maintained by the IMF, and it is the amount which India can immediately withdraw from IMF, but it is the smallest component. Now, what is the role of RBI in Forex stability? Now, these things you have to remember, because what they can do is that they can give you statement-based questions. So, with regard to that, you have to remember all of this. So, RBI's role in foreign exchange stability, one is the market intervention. Okay, the first one, it's with regard to the market intervention. That is, RBI, it actively uses reserves to stabilize the rupee. It is actively using reserves to stabilize the rupee. Now, what it does, for instance, when the rupee, value of rupee falls, the RBI can sell the foreign exchange. That is, the RBI can sell US dollars so as to counter depreciation, because when the value of rupee falls, it means that there is depreciation. To counter that depreciation, the RBI can sell US dollars, and vice versa, you can do it like that. Then with regard to liquidity management in the sense the RBI, it raised the ceiling on FCNRB deposits. Now, what is this FCNRB? Let me show you. What is this FCNRB? Now, this particular FCNRB deposits, they are the foreign currency. FC stands for foreign currency. NR stands for non-resident bank term deposit that non-residents Indian hold in India. Got it? There are bank accounts, there are deposits which the non-residents hold in India. So this is what is the foreign currency non-resident term deposits that the non-residents of India hold in India, and it is in freely convertible foreign currencies, typically for 1 to 5 years. Because it is a term deposit, so it is for 1 to 5 years. So what has happened is that the RBI, so as to encourage these type of term deposits with regard to the non-residents, so it has raised the ceiling on FCNRB deposits, and that too by 150 basic points. And this has mobilized and also mobilized special schemes like masala bonds, swap lines, so as to attract the capital. So these measures, they help to augment foreign currency inflow and strengthen reserves. So first role of RBI with regard to foreign exchange, forex stability, is market intervention. That means when the value of rupee falls, then the RBI can intervene by selling the US dollars As a result, it can counter the depreciation, but the liquidity management can also be done. Liquidity management as per raising the ceiling on the foreign currency non-resident bank term deposits, and this the RBI increased by 150 points, and also the RBI mobilized several of the special schemes. Why? So as to attract foreign capital to India. Then after this, we can say that you all must know that there is a difference between the Forex reserves and the sovereign wealth funds. Forex reserves, very importantly, maintained by the RBI. But sovereign wealth funds, they are government-owned investment funds. Remember it, they are government-owned investment funds. Government-owned investment funds. Here, when we talk about Forex reserves, then it is used for financial liquidity or stability. Then this is for long-term investment purpose. Then India, it has Forex reserves, but India, it has no major sovereign wealth fund like the government pension fund of Norway. But still, we can say that as of 2026, India's sovereign wealth fund is the National Investment and Infrastructure Fund, NIIF. This was established in 2015, and so as to channel capital into infrastructure and high growth sectors. In the same way, Bharat Sovereign Wealth Fund, BSWF, which is proposed on 2026, and it with a $50 billion corpus to manage state surpluses and foreign assets. Okay. So remember it, when we are talking about sovereign wealth funds, two of these sovereign wealth funds, they are important. One is NIIF, that is National Investment and Infrastructure Fund, and the second one is Bharat Sovereign Wealth Fund, BSWF. Okay? And what is the aim of this sovereign wealth fund? The aim is to reduce the fiscal strain, and the aim is to support the transition to a low carbon economy. Very, very important, transition to a low carbon economy, and also to support India's target of a $5 trillion economy by diversifying from traditional low yield foreign exchange reserve. That means the aim of this Bharat Sovereign Wealth Fund, or whatever is the sovereign wealth fund, its aim is to reduce fiscal strain, to transit to a low carbon economy, and also to support India's target of a $5 trillion economy. Got it? So, difference between Forex and sovereign wealth fund, very importantly maintained by the RBI, and here it is the government owned investment fund. Okay? And there are two such India's sovereign wealth fund, NIIF and BSWP. Okay? So this brings an end with regard to the foreign exchange, our discussion with regard to the first topic, that is foreign exchange reserve and the composition. Okay. Later on, we'll also talk more about how the foreign exchange works and all. I said you that FDI also we have to discuss. Don't worry about that. So this is a long session, and I would wish everyone to stay tuned with this session, because each and every topic which we are discussing, that is very, very important for your forthcoming prelims exams. Okay, so that's why we have brought this entire session, that is the score booster for your prelims 2026. Okay, so this is certainly going to help you out. I'm telling it to you. It's certainly going to help you out. And what happens is that your hard work, you are doing your hard work, and with this added, what you get a supplementary thing, and that would supplement your chances to get a success when it comes to the prelims 2026. So now let's talk about the Reserve Bank of India, RBI. Now when we are talking about banking thing, then Reserve Bank of India is very, very important. All of you must know, most of you know about this, that it was established on 1st April 1935, and that too under the Reserve Bank of India Act 1934. 1st of April 1935 under the Reserve Bank of India 1934. And it was initially a private shareholder bank modeled partly on the Bank of England. Then it was nationalized on 1st January 1949, and that too under the RBI Transfer to Public Ownership Act 1948. Headquarter, it is in Mumbai, moved from Calcutta. Earlier it was in Calcutta. 1937, it was moved from Calcutta to Mumbai. And the RBI Act 1934, this is the primary legislation governing the RBI. That means the primary legislation which governs the RBI is the RBI Act 1934. Now when we talk about the RBI Act 1934, some of the important sections which regard to this act, like for example, when we talk about section 17, it talks about the functions the RBI may perform. Section 20, it talks about RBI as a banker to the central government. This is the role which the RBI plays. Then section 21, RBI to transact government business. That means just like commercial banks, they do our business, they do transaction with our business. RBI is going to do transaction with regard to government, that is central government business. Then section 21A, it is RBI as a banker to the state government. And section 22, RBI's exclusive right to issue currency note. We all know that its sole function is the issuer of currency note. No other authority in the country can issue currency note. It is only the RBI. And then section 42 talks about the cash reserve ratio. That means it is mandatory that every commercial banks, out of their total deposits, they have to keep a part of it, they have to keep a certain percentage as been decided by the RBI as cash reserve ratio. That means that is what is a part of the legal reserve ratio. Then if you talk about the structure, then the RBI, it is governed by Central Board of Directors, Governor of the RBI appointed by the central government, and that too for a 5-year term, and it is renewable. Deputy governors, maximum there are 4, and 1 is in charge of the monetary policy. And the government nominated directors are there, and then there are directors elected by the shareholder. That is the nominal, the government holds all the shares. Nominally, the government is holding all the shares. And the local boards of the RBI, it is in Chennai, Kolkata, Mumbai, New Delhi, okay? They all advise with regard to the regional matters of the RBI, okay? Now when we talk about the functions, questions do come from the functions. Functions you can basically categorize into 6 main categories. First, monetary authority. All of us know that it is the RBI which has the monopoly to issue currency notes. So the currency notes are to be issued by the RBI. Monopoly is with the RBI. As a result, it is able to maintain price stability. Okay? And under section 22, we just saw, RBI has the sole right to issue currency note except rupee 1 coins and 1 rupee notes which are issued by the Ministry of Finance. That is, the coins and the 1 rupee note, it is issued by the Ministry of Finance. Rest rupees 2 to the other denomination of notes, that is being issued by the RBI. And coins are not issued, they are minted basically. and all currency notes are RBI's liability backed by assets. That means these currency notes, they are the liability of the RBI and they are backed by assets, that is gold, foreign securities, government securities and also the approved bill. So the first function should be clear with regard to the RBI. Second one is minimum reserve system. This minimum reserve system, it is used since 1957. That means the RBI has to maintain a minimum reserve of 200 crores. 200 crores, of which at least 115 crore must be in the form of gold against the total currency issue. Okay? So that is what is referred as minimum reserve. And the rest can be backed by rupee security. That means 115 crore in gold. So 200 minus 115 will give you what? 85 crores left. So that 85 crores, it can be backed by rupee security, approved foreign exchange, bills of exchange and so on. That means this minimum reserve system, earlier to this, there was the proportional reserve system. Now that has been replaced by the minimum reserve system. Then RBI also plays the role of the monetary policy. And we all know that since 2016, the monetary policy, it is conducted through Monetary Policy Committee, that is the MPC. And the MPC, that is the Monetary Policy Committee, it takes decision with regard to the monetary policy, and it is not a single person. Monetary Policy Committee, it's not a single person. Rather, it is a committee-based monetary policy. Remember it, a committee-based monetary policy. And when I talk about the monetary policy, total 6 members, from the RBI 3 including the governor, and external members 3 who are appointed by the government of India. Whatever is the decision, it is by the majority vote, and the governor has the casting vote in case of a tie. Okay? And what does this MPC decide? It decides the policy rate, that is mainly the repo rate, and the stance to meet inflation target. Okay? And latest MPC meeting, it was in April 2026. And what were the key decisions? You have to remember, very important for your prelims part. Repo rate, it remained unchanged, 5.25%. Standing deposit facility, it remained to 5%. Marginal standing facility, MSF, 5.50. Bank rate, 5.50. Policy stance will be neutral. Policy stance जो है, that will be neutral. Okay? And the target inflation will be 4%. And what will be the tolerance band? It will be, tolerance band will be 2% to 6%. That is 2% to the lowest side and 6% to the highest side. Okay? That is what. And all of us must know that there is an inflation target, and that inflation target is 4%. And this inflation target, it is set up by the government, and that too in consultation with the RBI. And the current target, remember it, current inflation target is 4% of the consumer price index inflation. 4% of the consumer price index inflation, and the range is 2 to 6. 2 to 6 means this is what is the tolerance band as such. Okay, so 4% minus 2 or plus 2. So minus 2 and plus 2, minus 2 if you do, it becomes 2%, and plus 2 if you do, it becomes 6%. So that's why the range is 2 to 6%. And India, it is following flexible inflation targeting. India is following flexible inflation targeting. And whatever is the inflation target, it is based on consumer price index inflation. Got it? It is based on consumer price index inflation. Clear, everyone? Okay. So, with regard to the inflation also, we have done the thing. Okay. Then there are certain quantitative tools which the MPC looks into. As I said, you repo rate, standing deposit facility, and so on. So how about discussing this quantitative tool with the help of this chart? Now this quantitative tool, first when I say repo rate, then it is nothing else but it is the rate at which banks borrow short-term funds from RBI against collateral. That means the banks have to keep collateral, and against that collateral, the banks borrow short-term funds from the RBI. And how it impacts the economy? If the repo rate is high, then the loans will be what? Costlier. As a result, there will be lower demand for the loan. And when the demand for the loans will be lower, as a result, what will happen? The price rise or the inflation will fall. Got it? So remember, whenever there is inflation, the repo rate is higher, and as a rate of higher repo rate, loans get costlier, and when loans get costlier, then the household and the firms, they are discouraged with regard to taking the loans. So there will be a lower demand and the lower inflation. Then comes the standing deposit facility, SDF. SDF is nothing else but it allows RBI to absorb liquidity from banks without providing collateral. Now, here collateral is provided, but here without providing collateral, RBI can absorb liquidity from the banks. So this helps to keep what? Excess liquidity under control and supports interest rate corridor. Then it is the MSF. What is this MSF? MSF is external borrowing window, and that is for the banks, and that too at a very higher rate. So MSF is always at a higher rate, and it is nothing else but emergency. All of a sudden there is an emergency. So in that emergency time, the commercial banks, they can borrow from the RBI, and that too at a marginal standing facility at a higher rate, and it acts as a ceiling for short-term rates and helps manage sudden liquidity stress. And finally, cash reserve ratio, the share of the deposits, bank deposits kept with RBI as cash reserves. That means every commercial bank has to keep a share of its total deposits with the RBI. And when the cash reserve ratio is higher, it means the commercial banks' lending capacity will fall. And when commercial banks' lending capacity will fall, as a result, the credit creation, or you can say the loans which the commercial banks will be providing, that can also be restrained. So these are the quantitative tools: repo rate, then standing deposit facility, marginal standing facility, cash reserve ratio. There are three more. One is open market operations. Now open market operations is what? The RBI either buys or it sells government securities in the market. That is, from the open market, the RBI will either buy or it will either sell. As a result, it will inject liquidity, but this injection of liquidity, it is only for a shorter period of time, and the selling absorbs liquidity. So either it will inject liquidity or it will absorb liquidity. See, when we talk about the open market operations, then the repo rate and the reserve repo rate, they are also a type of open market operations, but there the injection of liquidity or the absorption of liquidity, that is for a short period of time. But here the liquidity which is injected or the liquidity which is absorbed, that is for a long period of time. So open market operations is that. Then the LAF, that is the liquidity adjustment facility. That is daily or short-term liquidity management. Yay. That is what I was telling you. Key liquidity adjustment facility. Now this liquidity adjustment facility, it is done on a daily basis or for a short-term liquidity management. And this is through repo rate or through the reserve repo rate. Reserve repo rate is what? The RBI is borrowing money from the commercial bank. So for that it gives interest. So that is what is reserve repo rate. And this LAF jo hai, it aligns market rates with policy stance and all. And finally, for Forex intervention or swaps, that is RBI, it can either buy or sell foreign currency to manage volatility and liquidity impact. Okay, so this will help the exchange rate to stabilize and also can affect rupee liquidity. So overall, quantitative tool, we have done repo rate, we have done standing deposit facility, we have done marginal standing facility, we have done the cash reserve ratio, we have done the open market operations, liquidity adjustment facility, and also Forex intervention. I would request everyone, please go through these, you can say, quantitative tools in a very proper manner, because one question from here will certainly come. Okay, that is what. And all of you know open market operations, I did tell you about this. So nothing much to talk about when it comes to the open market operations. Okay, chalo. Next topic to be discussed here is with regard to the money market instruments and also with regard to the capital market. We all know that the financial market has two markets. One is the money market and the other one is what? The capital market. So when we talk about the money market instruments, here we have the G-Secs, that is the dated G-Secs. These dated G-Secs are what? These are the securities that carry a fixed or floating coupon rate. That is, they have either a fixed interest rate or a floating interest rate, and which is paid on the face value. That means whatever is the face value. For example, if the face value is 10,000 rupees, because the commonly traded denomination is what? 10,000. So on that face value, the interest rate, okay, is paid, and it generally matures, ranges 5 years to 40 years. So that's why it's a long term, you can say. And it is issued through RBI auctions on Fridays. Okay? So on Fridays, every Friday, the RBI through auction, it does it. So dated G-Sec, this is one. Then second one is treasury bill. You must be remembering treasury bill. It is issued by the RBI on behalf of the union government. So used by the central government, and that too to fulfill its short-term liquidity requirement. That is a liquidity requirement which has up to 364 days. And we can say that the maturity, it can be 91 day, it can be 14 day, or it can be 182 day, okay? And it can be 364 days. So the maturity period is either 91, 182, 14 or 364 days. Okay? And please remember, if there is a retail investor, now this is a very important for your prelims. If there is a retail investor, then the retail investor has to open a demat account so as to invest in the treasury bills or Government of India debt bonds. Okay? Matlab whatever are the Government of India debt bonds in the primary market, if a private retail investor or any retail investor is trying to invest, they have to open a demat account. And please remember, treasury bills are issued by the RBI on behalf of the government. They are also referred as zero coupon bonds also. Then comes the commercial paper. Commercial paper, it is issued at discount to their face value. That means face value se discount pe issue hote hain. And one of the most important sources of working capital finance of large firms. It is a very important, you can say, source of working capital finance. That means large firms, they need to get their working capital financed. So for that, commercial paper is used. Plus, it is an unsecured security. It's a short-term debt instrument and it is issued by companies, raise funds generally for a time period of up to 1 year. And it is in the multiple of 1 lakhs and subjected to minimum value of rupees 25 lakhs. And maturity is 14 to 1 year. Please remember, this commercial paper is very, very important. Then comes in front of us the commercial bill. Commercial bill, it is an unsecured security. And also when it comes to the small companies, so small companies use it to finance their working capital. Large companies, they raise their working capital from commercial paper. When it comes to the small companies, then source of working capital and issued by one merchant firm to another against credit transaction. And all we have to know is the maturity period 30, 60 or 90 days. Okay, 30, 60 or 90 days. And this commercial bill, it is used by all India financial institutions, non-banking financial companies, scheduled commercial banks, merchant banks, cooperative banks, they all use it. Okay. Then comes certificate of deposit, which we call it as COD. Now it is similar to the fixed deposits, but these are negotiable and tradable in the money market. And it is issued in the multiple of 1 lakh, minimum value 25 lakhs, again issued at discount, and you can say a security or a bond which is issued by the bank to the deposit. Then there is the interbank or call money. Interbank or call money is that you have to maintain a cash reserve. We all know that RBI tells every bank to maintain a cash reserve. Now, for example, a commercial bank is having less of the cash reserve. So what it will do is that it will do interbanking thing. So it will go for a call money. So call money, it is a short-term money market, okay, short-term money market which allows large financial institutions. When I say large financial institutions, it is basically the commercial banks to borrow and lend money at interbank rates. And these interbank rates, they are very, very volatile. Okay, they are very, very volatile. And this is for short term and its maturity period is 1 or 2 days, or maximum it can be 14 days, but not more than that. And it helps to optimize use of, and you can say call money rate jo hai, that is the interbank rate, call money rate. If the interest rate is high, then the RBI will buy securities and all. So very importantly, this is an interbank, that is the commercial banks within them, when they borrow with regard to maintaining their cash reserves, then call money market is being used. But call money market is only used when other you can say sources, the interest rate is high. Okay, so interest charged on such loans is called call money note, which is market determined. That's why I said it's very, very volatile. Okay. Then one more is the hundi. Okay. These are not discounted or accepted by banks. A commercial bank of unorganized sector or market, and it is issued by one firm to another against, and these are mostly on trust basis. Okay, mostly with regard to trust basis. Now very important is this notice money. Remember it, notice money, it is borrowing and lending of funds for 2 to 14 days. and it helps banks to manage their short-term liquidity mismatches. Okay? That means the bank can borrow like 25 crores for 7 days to meet its immediate obligation and repay it upon surplus realization. Okay. Then there is a term money, and this is beyond 14 days. Remember it? Now they can ask you this. 2 to 14 days it's notice money, and for beyond 14 days it is a term money. Okay. Beyond 14 days it is term money. Then there is the CBLO. You must remember this. This is collateralized borrowing. Collateralized is what? You are keeping a security against the loan which you are taking. That is what is collateral. So this is collateralized borrowing and lending obligation. Now this collateralized borrowing and lending obligation, it was introduced by CCIL, and that too to facilitate short-term borrowing and lending. Okay? That means those entities which do not have access to call money markets, those entities which do not have access to call money market. Now, if they want to borrow, short-term borrowings they want to do, short-term lendings, then they can use CBLO. Okay? So CBLO is a collateral-based borrowing, okay, and it is open to banks, financial institutions, mutual funds, insurance companies, and it is monitored by the RBI. Now, in the same thing, we have to also talk about the bonds and the bond yield. This is a very important topic for this year's prelims. Now, all of us know that bond is a debt instrument, and it is issued by the government. Issued by government or corporates so as to raise capital for specific period. To raise capital for the specific period. Now, when I say issuer pays the buyer a fixed interest which is called coupon, that means if I am the issuer of the bond, I will pay the buyer a fixed interest that is called as coupon, and returns the principal on maturity. That means on maturity, I will be returning the money to the buyer. So the face value here, there are three words: face value, market value, and bond yield. Face value is the nominal amount at which the bond is issued or on which the coupon is calculated. Coupon means interest is calculated. Market value is the price at which the bond trades in the secondary market, that is share market. And bond yield is what is the return the investor is earning based on its market price. Face value is the price at which the bond is issued. Market value, it is the price at which it is being traded in the secondary market. And bond return, it is the return which the investor earns on the bond based on its market price. Okay? And please remember, whenever the market price rises above the face value, market price rises above the face value, the yield or the return rate falls. Okay? And when the market price falls below the face value, the return rate or the yield rises. So there are two situations. One is the softening of the bond yield, and the other one is the hardening of the bond yield. Softening of the bond yield is when your return rate, it falls. And when does the return rate fall? When the market price rises above the face value. But when the market price falls below the face value, then there is higher yield or the yield rises. So that is called as hardening of bond yields. Okay? Got it? So this, if we keep it in a table format, remember, whenever the price falls, then market price is what? Lower. And when market price is lower, so as a result, what happened? yield will what happen? It will rise. That means when market price is lower than the face price. Okay, market price lower than the face price. So it's lower than face value. Okay, and whenever price rises, so what happens? Market price will rise than the face value. As a result, the yield or the return, it will fall. Now, here this situation happens, the causes is high inflation. Then when the RBI open market operation sale is being done, higher government borrowings, that is what. And this situation comes when there is a deflationary trend, or the open market operations RBI is purchasing and the borrowing is what? It is cut, lower borrowings. Okay. So here the borrowing rate, government borrowings, it will rise. Here the government borrowings will fall, and here there is a rate hike expectation, and here there is a rate cut expectation. So please remember, bond is nothing else but it is the return which is earned by the investors. And this bond yield, it can rise, it can fall. Rises when market price is lower than the face value, and it falls when market price is higher than the face value. And the causes here is high inflation, here it is deflation, here RBI open market operation sale, here RBI open market operation purchase, here the government borrowings is higher, here government borrowings is lower. Okay. Got it? Clear, everyone? And a very simple thing is that whenever we talk about the bond yield, the formula is annual interest divided by market price into 100. Annual interest divided by market price into 100. And the yield inversion curve, it is negative yield curve. That means an inverted yield curve represents a situation in which long-term debt instruments have lower yield than short-term debt instruments of the same credit quality. Remember it, the yield curve, it is always inverted. Inverted yield curve means whenever there is a long-term debt instrument, the yield will be lower. Whenever there is a short-term debt instrument, the yield will be higher. So that's why you can say that the yield curve, it is inverted, it is negative. And this is a formula. They can ask you some, nowadays what is happening is that they are asking questions, mathematical questions. So this can be like face value 1000 rupees, coupon, that is interest annually is, so market price is 1000. So what will be the yield? It is nothing else but the formula is annual interest divided by market price. So what is the annual interest? It is 100. Market price is what? 1000 into 100. So that is, if the price for that is yield is what? 10%. But now if the bond price falls to 900, now the bond price, it is falling to 900. So the market price falls to 900. So there is a fall in the market price. So when the fall market price, you can see you're getting higher yield. The bond yield आपका rise करेगा. Okay. So there are various bonds. First, we can talk about the masala bond. Okay. And the masala bond, it is issued by the Indian entities outside India, but denominated in Indian rupees. Masala bond you should know. Then fixed rate bonds. These are the bonds on which coupon rate, that is interest rate, is fixed for the entire life. That is fixed rate bonds. That is the coupon rate is fixed for the entire life. That is till maturity of the bond, the coupon rate will be fixed. Next comes floating rate bonds. Floating rate, the coupon rate will what happen? It will, you can say, it will be flexible. It will be variable. That is, every 6 months or every 1 year, you can say that is the coupon rates, it will be variable. Then the next type of bond, it is the console bond or it is the perpetual bond. Console or perpetual bonds, the issuer do not have to return the principal amount to the purchaser. In this, the issuer do not have to return the principal amount. This investment type does not have any maturity period and the customer benefit from steady interest payment for perpetuity. That means here the issuer does not have to pay the principal amount. So these are the catching points. Here if they say coupon rate is fixed, it is fixed rate. If they say that the issuer does not have to pay any principal amount to the you can say investor, to the purchaser, then that is with regard to perpetual bond or coupon bond. So these sentences which I have brought here, these are the catch points you can say with regard to your exams. Then there is the zero coupon bonds. Zero coupon bonds, they are sold on discount and repurchased at the face value. That means they are issued at discount and redeemed at par, like the treasury bill. Like 25,000 is the face value, it is issued in 20,000 and it is purchased back in 25,000. So 5,000 is the coupon and it pays no interest as such, but it is a zero coupon bond. Then there is the bearer bond, that is the fixed income security that is owned by holders or bearers rather than by a registered owner. So bearer bond is there. Then the capital index bond, these are the bonds, the principal of which is linked to an accepted index of inflation. So you must be remembering these type of bonds. Okay. Then bonds with call, that is put options. That is bonds with call. That is, there are bonds which can be issued with features of options, wherein issuer can have option to buy back or the investor can have the option to sell the bond. That is call option and put option. Remember it. Call option where the issuer can have the option to buy back the bond, and put option where the investor has the option to sell the bond, okay, to the issuer before the maturity of the bond. Then negative yield bonds, we all know that the debt instruments that pay the investor a maturity amount lower than the purchase price. That means if you have purchased at 1,000 rupees and your maturity, on maturity you are getting 900. So that is what? Negative yield bonds. Okay. So these are the, and one special zero coupon recapitalization bonds. These are, you can say, special type of bonds which are issued by the central bank. Okay. So this particular thing you have to remember it. Okay. Then we have the Uday bonds. Remember it, Uday bonds. To reduce the debt burden of DISCOMs, wherein the states would take over some percentage of their debt obligations. That means the debt burdens of DISCOMs, to reduce it, the state, what it does is that it takes some percentage of the burden of the debt burdens of the DISCOM. And in return, DISCOMs, what they are required to do is that they are required to implement structural reforms so as to improve their financial viability. So the government issues Uday bonds to banks and other financial institutions to raise money. So Uday bonds are basically to DISCOMs. Then there are Maharaja bonds. Maharaja bond is what? Rupee denominated bonds which are issued by International Financial Corporation. Then there is the Munni bond. It is the bond which is issued by urban local bodies to raise money for the development of various capital intensiveness. Bengaluru Municipal Corporation, it has issued municipal bonds for the first time, Munni bonds. Okay. Then there is the Elephant bond. This was proposed by Surjit Bhalla committee. Elephant bond is people who are declaring undisclosed foreign income will be required to invest 50% in elephant bonds, and that will be used to finance infrastructure. That means anyone who is trying to declare their undisclosed foreign income, like 100 crores, then out of that 100 crores, 50 crores will be used for used in the elephant bonds, and that will be used for financing infrastructure. Then the impact bonds. Impact bonds, these are unsecured bonds, and they are raised to fund projects which have social impact or development. Then there are sovereign gold bonds. Already I have said you, sovereign gold bonds, that means the government securities, they are denominated in grams of gold, and the investors, they pay the issue price in cash, and the bonds will be redeemed in cash on maturity. Then there is the green bond. It is with regard to environment, and the first green bond issued by European Investment Bank in 2007. That is the climate awareness bond, very, very important. Then there is the panda bond. This is yuan denominated bonds issued by China. Okay, panda bonds. Then uridashi masala bonds. It is a special type of masala bond of Japan. It is bought by Japanese retail investors. Uridashi masala bonds. And the Bharat bond ETF, that is, you can say it is issued by the central public sector enterprises. Okay, and the minimum investment is 1,000. Okay, so these are the various types of bonds which we have to remember. Okay, and these are the tables here. Remember it, like government securities, GSEC, Government of India, issuer is Government of India, Treasury, purpose, maturity, and here safest because sovereign bank, exam trap, so it will be government securities. Then these are discount instruments, no coupons, it is treasury bill. Then state development loans, that is SDLs, state governments, similar to GSEC, issued by states, not center. Then corporate bonds or debentures, companies raise business capital and not issued by RBI. Then municipal bonds like urban local bodies, Munni bonds and all, they are rare but growing in India, like Bengaluru had the first one. Okay, so these are the table which I have brought it for you. You can just, I have already explained it. I'm just moving aside. You can click, you can just have a screenshot of these tables. It is very, very important. I'll show you the previous one. Have the screenshot 1, 2, 3. Okay, so I'll count 1, 2, 3. Have the screenshot 1, 2, 3. So these screenshots are very, very important. Okay. Got it? Now, next which we have to go with is with regard to your, I can say, it's with regard to the external investment types. I already said you, there is the direct investment and the indirect investment. And when I say direct investment, it is foreign investment. Now, foreign investment, it can be direct, it can be indirect. Foreign investment, direct when wholly owned subsidy. Wholly owned subsidiary, that is investment in the business by foreign citizens, usually involving majority stock ownership of the enterprise. So, wholly owned subsidiary, where the business, investment in the business is done by foreign citizen and they have a majority stock ownership of the enterprise. And direct investment, there is also one more, that is joint venture, that is between foreign and domestic companies. So direct investment is two wholly owned subsidiary and the second one is joint venture. Then indirect investment, this is investment by FII, that is foreign institutional investment. foreign institutional investment. Okay, so this are the two foreign investments. Then foreign investment is foreign direct investment and foreign portfolio investment. Now when we talk about foreign portfolio investment, the routes are automatic as well as the government routes, remember that. Then foreign direct investment may more than 95% of the foreign direct investment comes in India through automatic route, remember it. It comes to India through automatic route, an automatic route where no government approval is required, and they are subject to only sectoral laws. Okay, they are subject to only sectoral laws. So 95% of the FDI comes in India through automatic route. And then we have the forms of FDI. One is the greenfield FDI. Greenfield FDI, it is a direct investment in new facilities or the expansion of existing facilities. That means either existing facilities expansion, the investment is made, or with regard to a new investment. And the principal mode of investing in developing countries. This is the greenfield investment. The second one is merger and acquisition. Merger means either they will merge with the local companies or they will take up the local companies. They will buy the local companies. That is when transfer of existing assets from local firms takes place. Okay. Then when we talk about the types, they are categorized as horizontal, vertical and conglomerate. Horizontal FDI, when a company establishes same type of business operation in the foreign country. That means whatever business operation you had in your home country, the same type of business operation you will have in the foreign country, so that is called as horizontal FDI. Like US based cell phone provider, they are buying a chain of cell phone stores, okay? And in China is an example. So that means they establish the same type of business operations in foreign country as it operates in its domestic country. Then in the same way, in vertical FDI, what happens is that in vertical FDI, a business acquires a complementary business in another country. Like US manufacturing might acquire an interest in a foreign company that supplies it with raw materials. That means the business is trying to acquire a complementary business. That means, for example, the US garment industry is there. Now, it is trying to acquire that industry in India, which is supplying the raw materials to this US garment industry. So that is with regard to vertical FDI. That is business, acquiring a complementary business in another country. And conglomerate FDI is what? A company which invests in foreign business that is unrelated to its core business. That means its core business is with regard to, for example, coal mining and all. But in India, it has invested in you can say leather garments, or it has invested in garment industry. So it is entirely not related to the business, core business it is doing. Okay, so three types of foreign direct investment: horizontal, vertical and conglomerate. Got it? Then we talk about the FPI. I have already said you FPI, it is the foreign portfolio investment, an investment by the non-residents, and that too in the Indian securities such as share, bonds, debentures and derivations. And this we can say foreign portfolio investment, it is only with regard to the equity things and all. And when we talk about the foreign portfolio investment, then if you differentiate, actually this has gone in two different pages. So foreign direct investment, it's only in equity shares, whereas foreign portfolio, it is both equity and debt. That is one. Number two, it happens through primary market, and foreign portfolio, it happens generally through secondary market, but can happen through foreign primary market as well. Then the foreign investor appoints board of directors and involved in decision making. That means in foreign direct investment, the foreign investor is appointing the board of directors and is involved in the decision making. But in portfolio, as I said it to you earlier, the foreign investor generally do not get involved in decision making. Okay, and it is sector specific, and this is capital market. So it is a general capital market. It can be sector or company something, and it is generally short-term investment, and this is generally long-term investment as it turns the company to profit. So there is a difference between FDI and FPI. It is only for equity shares, only through the primary market. The foreign investor appoints the board of control and is controlling the decision making, sector specific and long-term investment, whereas it involves both equity and debt. It is only through the secondary market but also through the primary market, and it generally does not involve in the decision making the investor, and it is in general capital market, that is sector or company, both can happen, and generally short-term investment is involved here. Got it? External borrowings already we have done, no need to talk about that. Special drawing rights also I have already talked about it. It's only a repetition there. Now there is a GDR or American Depository Receipts, Global Depository Receipts, American Depository Receipts. All of you must remember that it is a negotiable instrument that can be traded like any other security instruments freely. Negotiable instrument. And via this, the investor wants to invest money in a company listed in India. Okay? So under this, Overseas Depository Bank gives an acknowledgement slip to the investor that some shares are being held on your behalf. So this acknowledgement slip is called Global Depository Receipt or American Depository Receipt in case of US investor. Got it? So here it's a negotiable instrument which can be traded like any other security instruments. And here the investor, what he does is that via this he tries to invest money in a company which is listed in India. Okay? Which is listed in India, in which he cannot directly invest. So via this he does this, and what happens is that the Overseas Depository Bank, it issues a receipt, and that receipt is referred as Global Depository Receipt. It is an acknowledgement receipt that you are holding certain shares, okay, in this particular company, okay, and that is also referred as American Depository Receipts. Okay, got it? In this same foreign exchange rate also, one thing you must remember, there is concept like depreciation and appreciation. Whenever I say currency depreciation is, it simply happens like when I say $1 30 rupees and $1 40 rupees. Now, is this currency depreciation? That is this depreciation of Indian rupees? Yes, it is depreciation of Indian rupees. Why it is depreciation of Indian rupees? Because earlier an Indian had to part away 30 rupees to buy $1 worth of American good. Now the Indian has to part 40 rupees, that means 10 rupees more, to buy the same $1 of American rupees. It means that depreciation is nothing else but it is the fall in the value of your domestic currency with regard to the, as compared to the foreign currency. And what about appreciation? It's $1 30 rupees and $1 20 rupees. That means whenever the foreign exchange rate, this is foreign exchange rate, whenever it rises, it leads to depreciation. Whenever the foreign exchange rate falls, it leads to appreciation of your currency. That means simply take it as this, $1 30, it means the American comes here, gives $1, gets 20 laddus, 20 Indian laddus. Next, again he gives $1, he gets only he gets 30 Indian laddus initially, and then he gets 20 Indian laddus. It means that Indian laddus have become what? They have become what? Costlier. So it means when our goods become costlier, then our currency appreciation takes place. And when our goods become cheaper, then it becomes depreciation. Please remember, foreign exchange rate, it can be determined by the government, it can be determined by the market forces. When determined by the government, it is called as fixed exchange rate or pegged exchange. Pegged means with regard to some gold or, and when it is fixed by the market forces, it is called as flexible or floating exchange rate. Got it? And whenever there is fixed exchange rate, there is not appreciation and depreciation, it is appreciate and depreciate. And when it is by the market forces, it becomes appreciation and depreciation. So this is something which I wanted to discuss it with you. And also remember, there is a managed floating exchange rate. Now in this managed floating exchange rate, it is the RBI which is playing the role. That means it is a mix of flexible exchange rate and a fixed exchange rate. That means if rupee has become very volatile and is depreciating against dollar, RBI starts selling dollars in the market. And that means here the role of the RBI is very, very important. That means whenever there is a depreciation sort of situation with regard to the rupee, then the RBI will sell dollars from its reserve. Whenever there is an appreciating type of situation with regard to the rupee as compared to dollars, the RBI will buy foreign currencies from the market. Please remember, this thing the RBI does only to protect the interest of the exporter and importer. That's why it is referred also as dirty floating exchange rate. Remember it, it's also referred as dirty floating exchange rate. And there are very, very important things with regard to NIR and RIR. Remember it, NIR, it is the weighted average value of nominal exchange rate of rupee. Now nominal, what is this nominal exchange rate? It is a relative price of currency of two countries. Nominal exchange rate is relative price of currency, like $1, 40 rupees. So this $1, 40 rupees is nothing else but $1 can be exchanged in return of 40 rupees, or 40 rupees you give, then you get $1. So it is a relative price of currency between two countries. And when I talk about real exchange rate, then it tells us the rate at which we can trade goods of one country for the goods of another, and is the relative price of goods of two countries. So real exchange rate is nothing else but it is the price at which you can trade goods of one country for the goods of another country. So it is basically the relative price of goods of the two countries. So nominal effective NIR, it is weighted average value of nominal exchange rate, okay, against the currencies of major trading partners. And RIR, it is the weighted average of real exchange rate of rupee against currencies of major. So this is with regard to nominal exchange rate, this is with regard to the real exchange rate. Okay, got it? So this is very, very important. And there is a capital account convertibility. This capital account convertibility, you have to remember, SS Tarapore committee had recommended to move towards full capital account convertibility. That is currency convertibility, the ease by which a country's currency can be converted into gold or another currency. So India mein there is full convertibility with regard to current account, remember it, and only partial convertibility with regard to the capital account. This is very, very important for your exams. Okay, and last, I should not forget to tell this, there are there is a topic with regard to your national logistic policy. Now this NLP, National Logistic Policy, it was launched 17 September 2022. And this is to develop a technologically enabled, integrated, cost-efficient, resilient and sustainable trusted logistic ecosystem. So remember, the launch date you have to remember 17 September 2022. Okay. And it is for accelerated and inclusive growth. Okay. And India's ranking with regard to logistic performance index, that has been improved by 16 places. Okay. 16 places. And this national logistic policy, it was to complement the Pradhan Mantri GatiShakti mission. Pradhan Mantri GatiShakti mission. Okay? So that is very, very important. And the main aim is to reduce the logistic cost that is comparable to the global benchmark by 2030, improve logistic performance index to become among top 25 logistic performance countries by 2030. States notified that state level logistic policy and data driven decision support mechanism. Okay. This logistic policy, you have that ULIP. U stands for unified, L stands for logistic, I stands for interface, P stands for performance. Very, very important, this short form and its full form. ULIP. Unified Logistic Interface Performance. Okay. So for this, the digital gateway, it was launched in 2022. Then ULIP APIs, it is developed 196 applications and 145 private players, 44 systems of 11 different ministries through 135 APIs covering 2000 field. So this is very, very important. And logistic data bank project, that is to real-time tracking of EXIM container movement, then 5,800 railway stations, freight operation information system. Then, but these all are not, that short form is very, very important. As I said you, Pradhan Mantri GatiShakti National Master Plan. So this is Pradhan Mantri GatiShakti launched 2021. Okay. And basically digital platform, national master plan, transforming India's infrastructure landscape, improving of living, then 57 central ministries. Okay, 57 central ministries, your department, and 36 states and union territories. That means all 28 states and 9 union territories, they are on board. Okay. So this is Pradhan Mantri GatiShakti. It is basically with regard to the logistic, and also promoting Make in India initiative through Pradhan Mantri Ekta Mall. And this Ekta Mall, its highlight is what? One district, one project. And 27 states, 29 Pradhan Mantri Ekta Malls and 23 construction जो है और initiate हो गया. Okay. So overall, we can say we have covered most of the things. So at last, I would say all of you that some more thing, like you must be going through the, you can say major, you can say financial institutions like NABARD. Please remember, go through that NABARD part also. Go through that SIDBI part also. Then also with regard to the EXIM banks, okay, you have to go through these things very importantly. And not to forget, you have to know about the topic with regard to your GDP deflator and all. That is the GDP deflator and all. That is in India. The inflation is measured by CPI, WPI and GDP deflator. CPI, it is the retail consumer price. WPI, it takes the wholesale price, producer price. And GDP deflator, it is the prices of all final goods and services in the GDP. Okay? So CPI is basically, you can say there are various variants in the CPI. You can just, I have a separate video for this particular CPI. You can go through that CPI video. The video was particularly named as GDP deflator versus CPI versus WPI. You can find that video in the YouTube itself. All you have to do is that you have to subscribe, you have to just be a part of the YouTube channel of Drishti. And at last I would say that most of the topics which we have covered, they are very, very important for your prelims. And so all the best to all of you.
For more informative content, like, share and subscribe, and do not forget to press the bell icon to get the notifications.